turn to the earnings that we're starting to get. Capital One is out, Jeff. Obviously, Capital One, a winner today, also a winner because that Discover Financial deal actually got regulatory approval, went through. Discover Financial up even more than Capital One. But it looks like maybe a mixed report for Capital One. What are your thoughts based on the numbers that you're seeing?
I'm seeing it come in. It looks mixed. It looks a little bit below expectations on earnings and revenue from what I can tell. Not a major shock, but certainly something that investors are paying attention to. I think to your point, we saw them rise big on that merger deal. It's expected to close in May now. It's going to make them a huge player in the banking space. And I think that that's a big deal. Now going forward, as we look through these numbers, I think the focus is going to be on what are we seeing revenue-wise from the credit card. That makes up a big majority of their revenue. Expectations it was going to be up almost 8%. What we're seeing out of net interest margin, and then of course, the hurdles that tariffs could be putting. We haven't really seen an outlook from this company. We know provision losses have been up in the past. I imagine as I come through this report, that's going to continue to be the same thing. But roughly half of their portfolio, is composed of credit card receivables, right? Net charge-offs are about 6%. There's a big concern that if we're seeing some worry going forward in the financial sector, we could see those charge-offs rise substantially. I mean, if we look back at 2009, they were closer to 10%. That really hits margins very hard, profit margins very hard.
Okay. All right. Well, we'll certainly pay attention to the earnings call there just for any insights into the consumer as well. But does look like a top line miss. Revenue fell 2%, just kind of narrowly missing analyst expectations. But it looks like the stock right now actually rising a little bit, adding to those gains from earlier today. I do want to shift gears to Tesla, Scott, because Tesla numbers are out. I think every headline that I saw previewing these numbers talked about how this could be a messy report. There could be more pain for Tesla. It's not going to be a good one. It looks like we saw a nice little pop initially on this report. We did get a pop in Tesla shares today. Shares closed up more than 4%. And doesn't really seem like investors know how to react based on this initial reaction. What's your initial reaction to the numbers that you're seeing?
This is a messy report time, especially for Tesla. There's so much going on that's outside of the numbers, with the whole Doge thing and the Elon Musk. And, we have comments today from important people saying that Musk's better get back into the game or we're going to have trouble. These numbers, the numbers are extremely important. There's no question. But we've got to see Tesla not just increase their revenue, but increase the number of sales. We're down in sales this quarter. I don't know. I haven't seen last quarter. I'm not exactly seeing the sales for this quarter, but we've been down. Tesla has some brand repair they need to be doing from political reasons, et cetera. See how that all works out.
So I'll give you the numbers here. Sales came in at $19.34 billion. So certainly lower than the year ago period and lower than what analysts were looking for at around $20.98 billion. Also bottom line miss, EPS of 27 cents, missed the 41 cents per share or 44 cents per share, depending on the estimate that you're looking, that analysts were expecting. So, Jeff, this is a top and bottom line miss. I think the question is, obviously we knew deliveries fell short of expectations, even though the expectations had been lowered for the first quarter. I think the big question is how much will investors pay attention to these numbers, even though they're the fundamentals. The automotive business is what, 85% of revenue or something, or how much do they look forward to Elon Musk's commentary about the future and AI and robotics and FSD?
Commentary. I mean, I think this is one of the few earnings reports where yes, to your point, we already know about the misses on deliveries and production. That's already been built in. Deliveries fell short by about 14% or fell by about 14%, excuse me. And so right now, if you asked an investor in Tesla, what matters most to them, they're not going to put the earnings and revenue at the top of the list right now because there's still a lot of questions, certainly about Musk's time spent away from Tesla, how that's affecting the company. Margins being squeezed in this kind of highly competitive environment, especially in China, that's pushing Tesla's prices lower. At the same time, rates are high, tariffs are playing a role in supply chains and prices there. There's some uncertainty among investors. And then finally, what you're pointing out, this is the other side of that story, what's happening right now and then long term, self-driving cars, the new cheaper model, robotaxis, even the robots. When are these rolling out? What do we expect this to do to revenue? Is this going to bring Tesla back? Because we're looking at a year, 2024, when we saw, 77% of revenue was from EV sales, but it declined 8% year over year, right? First unit drop in deliveries. So this is they need a comeback story, and that's going to come from the call.
Okay. Well, and I am seeing some headlines just to fill you in terms of that robotaxi rollout. Continue to prepare for launch of FSD in Europe this year, pending regulatory approval, and Austin by June. So there was some questions about the timeline there. It looks like they're still on track for a June launch there. So we're going to leave it there. We're going to continue to dig into these numbers as well. But Jeff Pierce, Senior Manager Derivatives Trading at Charles Schwab, Scott Dufrey, Senior Manager Trading Services, Charles Schwab.